Last Tuesday night in Charlotte, North Carolina, a couple in their late 30s, Marcus and Jenna, sat at their kitchen table at 10:47 p.m. with a calculator and a stack of bills. Marcus is 38, software engineer, earns $128,000. Jenna is 36, HR manager, earns $87,000. Combined household income, $215,000, solid upper-middle-class income for any American city. They had just paid the month's bills. They had, at that exact moment, $312 left in their checking account, to last them 11 more days until the next paycheck. Marcus said one sentence to Jenna I have heard from over a dozen high-earning couples in the last year. He said, "My dad raised 4 kids on $52,000 a year. We make 4 times that. Why are we always broke?" That is the most important financial question of our generation. I'm Trish, and I read the policies and the math behind it. So by the end of this video, you'll understand exactly why your $200,000 is not what you thought it was, and what to actually do about it. This is not a Marcus and Jenna problem. This is a generational problem. The data is brutal and consistent. 40% of Americans earning over $100,000 a year now report living paycheck to paycheck. It gets worse as you climb. 41% of households earning $300,000 to $500,000, 40% of households earning over $500,000 are in the same situation. Read those numbers again. Earning $500,000 a year, paycheck to paycheck, 4 out of every 10 of them. This is not a budgeting problem. This is not a they should just spend less problem. There are millions of high-earning households doing everything they were told to do. Going to college, getting the good job, getting the promotion, marrying a fellow earner, and still ending up at the kitchen table at 10:47 p.m. with $312 in their account. There are 3 specific traps that have collapsed the American middle class, even at the upper end of it. Once you see the 3, you can name what's happening to you, and then you can fix it. The fix isn't earn more. James, the plastic surgeon you met earlier in this series, earns $720,000 a year and has a negative net worth. The fix is structural, and it starts with understanding why the math broke. One quick framing. For 50 years, roughly 1950 to 2000, there was a simple equation in America. Earn $80,000 in solid middle-class money. You owned a house, raised kids, took a vacation, retired comfortably. Earn $200,000, you were rich. Country club, boat, second home. Send the kids to private college without flinching. Today, $80,000 buys you a small apartment, no kids you can afford, no retirement savings, and a permanent state of financial stress. $200,000 buys you a starter home in a mediocre neighborhood, 2 kids in expensive daycare, a leased car, and exactly $312 in your checking account on the 21st of the month. The income numbers didn't shrink. The dollars shrunk. Plus the cost categories you didn't have in 1995, childcare at 5-figure prices, health insurance premiums up 200% in 15 years, $300,000 college bills, all of those expanded to fill the larger paycheck. 3 traps. They compound on each other. None of them are your fault. All of them have specific fixes. Let's break them down. Trap 1. The inflation compound. This is the trap nobody talks about plainly, because the math is depressing. Cumulative inflation since 2020 is somewhere around 26%. That is the official number, the Consumer Price Index. The real number for working middle-class families is higher because the goods and services you actually buy, groceries, daycare, insurance, housing, went up faster than the basket the government tracks. What does that mean in dollars? A $200,000 salary today, in real purchasing power, buys you what about $158,000 bought you in 2020, and about $140,000 bought you in 2018? In other words, Marcus and Jenna are earning $215,000 on paper. They are living like a couple earning $150,000 in pre-pandemic money. Their salary number went up. Their actual life got smaller. A dozen eggs went from about $1.40 to over $3.60 in 5 years. A loaf of bread is up 35%. Ground beef is up over 40%. Auto insurance premiums for the same car are up an average of 47%. Home insurance, the same house, no claims, is up an average of 33% in the past 4 years alone. Marcus's father raised 4 kids on $52,000 in the early 1990s. In today's purchasing power, that $52,000 was worth approximately $112,000. He was earning the equivalent of $112,000. Marcus is earning $128,000. It's the same paycheck. This is not a Marcus problem. The numbers literally moved under his feet. The fix on Trap 1, this is the one most people miss, is income ladders, not side hustle. Salary negotiation every cycle. Job hop every 2 to 3 years to capture market wages. Switch careers proactively if your industry is in slow growth. The people who doubled their salary between 2020 and 2026 are roughly even on purchasing power. The people whose salary went up 8% over 5 years are 18% poorer than they were. If you haven't asked for a raise in the last 12 months, that's where the conversation starts. The system rewards people who ask. Trap 2. The lifestyle tax. This is the trap that quietly eats high-income households alive. The necessity creep. In 1995, a middle-class American family had a list of costs that looked like this: mortgage, groceries, 1 car, 1 phone bill, basic health insurance, savings. The 2026 list looks like this: mortgage at a much higher price-to-income ratio, groceries, 2 car payments, often leases, 4 phone lines on installment plans, premium internet, multiple streaming services, gym memberships, before-school care, after-school care, summer camp, sports leagues, tutoring, and HSA. You fund every year because the deductible is now $7,000, life insurance, disability insurance, 2 BNPL apps you don't track, an Amazon habit, and the 4-figure annual cost of events you have to attend: weddings, baby showers, graduations, work conferences, kids' birthday parties. Each item by itself is reasonable. Combined, they consume the entire upper-middle-class paycheck. Let me give you Marcus and Jenna's actual numbers. Mortgage on a $410,000 starter home in suburban Charlotte, $2,940 a month. Property tax, $385. Home insurance, $215. Total housing, $3,540. About 25% of their gross income. Reasonable on paper, punishing in practice. Childcare for their 2 kids, ages 2 and 4, $2,800 a month. That's $33,600 a year. After tax, off the top. 2 car payments, $740 combined. Auto insurance for 2 adults with no tickets, $310 a month. Total cars, $1,050 a month. Health insurance through Marcus's employer, $1,180 a month for the family plan. With a $7,000 deductible, they have not yet hit. Total annual health spending, closer to $20,000 per year by year end. Groceries for a family of 4 with toddlers, $1,400 a month. I have not yet listed phone, internet, streaming, gym, school activities, gas, savings, or anything discretionary. And we're already at $10,510 a month in non-negotiable expenses. Their take-home, after taxes and 401k contributions, is roughly $11,800 a month. That leaves $1,290 a month for everything else: gas, phones, internet, streaming, eating out, gifts, clothes, repairs, vacations, doctor copays, anything unexpected. It's not that they're living wastefully. The lifestyle tax of being an average upper-middle-class American family in 2026 eats $200,000 by structure. The fix on Trap 2, and this is unpopular, is to attack the big three. Housing, childcare, transportation, not the latte, not the Netflix, the three categories that make up 65% of the high-income family's budget, buy 30% less house, drive cars 8 years longer, find creative childcare structures, nanny share, family help, employer-provided daycare. Renegotiate one of those three this quarter, and you free up more cash flow than 200 canceled streaming subscriptions ever will. Trap 3. The tax bracket punch. This is the trap nobody warns you about until it's too late. When Marcus and Jenna both cross into six-figure individual salaries, an interesting thing happens to their tax math. Their marginal tax rate jumps. A single earner at $100,000 is in the 22% federal bracket. Combine two earners at $215,000. They cross into the 24% bracket. Their North Carolina state tax adds another 4.5%. FICA takes 7.65%. So on every additional dollar Marcus earns above $215,000, he keeps about 64 cents. That's before local taxes, sales tax, gas tax, property tax, and the dozens of small consumption taxes built into modern American life. Worse, at $215,000 combined, they have phased out of almost every tax break designed to help working families. They make too much for the saver's credit, too much for the child tax credit phase-in benefits, too much for the student loan interest deduction, too much for direct Roth IRA contributions. They have to do the backdoor route. Too much for FAFSA financial aid for their kids' future college. Marcus, on 4 times that income, qualifies for almost none. This is sometimes called the donut hole of American tax policy. Below $80,000, you get help. Above $400,000, you get sophisticated tax shelters and an accountant. Between $200,000 and $400,000, you pay full freight on every dollar with almost no offsets. The fix on Trap 3 is aggressive tax advantage saving. Max the 401k, max the HSA, backdoor Roth IRA every year. If your employer offers a mega backdoor Roth, use it. If you have a 529 plan available, use it. Eleanor, the family practice doctor from yesterday's video with $4.1 million, earns $340,000. Her secret isn't lower spending. It's $80,000 a year in tax-sheltered accounts. Every year, for 25 years, that's $2 million of her $4.1 million in tax-advantaged accounts alone. The IRS has built specific carve-outs for high-income earners to shelter retirement money. Most people don't use them because they don't know about them, or because the amount feels like it would crush their lifestyle. It won't. It's just rerouting. That's the 3 traps: inflation compound, lifestyle tax, tax bracket punch. When all 3 hit a household at once, Marcus and Jenna at the kitchen table at 10:47 p.m. is the result. Not because they are bad with money, because the system is set up to extract maximum value at exactly the income level they hit. Once you see the trap, you can navigate it, not earn your way out, structure your way out. 3 objections come up here. Let me handle them. Objection 1. We don't make $200,000. What does this have to do with us? Everything. Because the trap scales down. The same 3 forces that crush a $215,000 household are crushing a $75,000 household harder. Higher percentage of income going to housing, higher percentage to childcare, same inflation, same lifestyle tax pressure. If you're at $75,000, the playbook is identical. Attack the big 3, housing, childcare, transportation, max your tax-advantaged accounts up to whatever you can, and ladder your income aggressively. The math doesn't change with income level, only the dollar amounts do. Objection 2. Marcus and Jenna sound like they're spending too much. Pull out a calculator. Their non-negotiable monthly burn, housing, childcare, transportation, food, healthcare, is $10,510. Their take-home is $11,800. They have $1,290 left for everything else. That is not spending too much. That is the structural cost of being a dual-income family with 2 young children in a mid-size American city in 2026. You can argue they should buy less house. Sure, they could move to a $300,000 house in a worse neighborhood and free up $700 a month. They could put 1 kid with a relative for daycare and free up $1,200. These are real options. They have real costs, commutes, school district quality, family dynamics. But they're spending too much on lattes isn't the answer. Lattes aren't on the list. The list is the life, and the life is structurally expensive now. Objection 3. I make $200,000 and I'm fine. What's the big deal? If you're at $200,000 and you're fine, congratulations. You either live somewhere with low cost of living, you have no kids in childcare, you have a paid-off house, or you're doing a few specific structural things right. You are not the average. The data says 40% of your income peers are not fine. They are paycheck to paycheck. If you're in the fine group, this video is about helping you keep the gap. The same 3 traps will eat you eventually if your income stays flat and inflation keeps moving. The fixes I'm about to give you in the action steps protect what you've built from the same forces that ate everyone else. Action step 3 steps. This week, none of them are optional. Step 1. Tonight, the income audit. Pull your last 3 pay stubs. Calculate exactly what your gross to net is. Then compare to your salary 24 months ago. If your gross income has not increased by at least 12% in those 24 months, you are losing the inflation race. Every year you stay flat, you get poorer. This week, do one of the following. Research salary data for your role on Glassdoor, levels.fyi, or comparable sites. If you're underpaid, set a calendar reminder to ask for a raise within the next 30 days. If you're at market for your current role, start applying to roles that pay 15 to 20% more. The single biggest move on Trap 1 is income laddering. It outweighs almost every other personal finance move you can make. Step 2. This weekend, attack one big 3 category. Pick one of housing, transportation, or childcare, whichever is your biggest pain point. For housing, if you're renewing a lease at a 6% increase, push back. If you have a mortgage, look at refinancing if rates have moved. If you bought too much house, start the difficult conversation about downsizing in the next 18 months. For transportation, if you have a leased luxury vehicle, run the math on getting out. If you have 2 cars and could run with one, sell one. If your car payment is over $500 a month, it's hurting you. For childcare, explore nanny share, employer-provided daycare benefits, family help, or a part-time arrangement. Even shifting from full-time to 4-day childcare can save $400 to $700 a month. Pick the one. Make one move this weekend. Step 3. This month, tax shelter maximization. Open every retirement account you have access to. Calculate exactly how much of the 2026 tax advantage limit you're using. The limits: $24,500 for 401k, $4,300 for individual HSA, $7,500 for IRA, backdoor Roth if you're over the income limit, $3,300 for FSA. If you're contributing less than 80% of what you're allowed, you are paying voluntary taxes you don't have to pay. Bump up the contribution rate this month. You will not feel it on your next paycheck nearly as much as you think. Eleanor shelters $80,000 a year. That's roughly $25,000 a year she does not pay in taxes. That's $625,000 over 25 years, just from using the legal shelters. You will not unwind a lifetime of compounding tax inefficiency in 1 month, but you can start. This month, 3 steps. Income. One big 3 category. Tax shelters. The paycheck to paycheck cycle starts to break within 90 days. If this video helped you, or if you've been the Marcus or Jenna at the kitchen table, do me one favor. Hit the subscribe button. New video on this channel every single day. Each one is a specific move that puts real money back in your pocket. Same way this one just did. And here's what's coming tomorrow that I think is the most important video in this entire series. You met Eleanor, $340,000 a year, $4.1 million net worth. Lives well, dresses well, sleeps well at night. You met Marcus and Jenna, $215,000 a year, $312 in checking, kitchen table panic at 10:47 p.m. The difference between them is not income. It's not luck. It's not hours worked. Tomorrow I walk you through the entire code, not just clothes. The dress code was yesterday. The complete life code. The decisions that separate the Eleanors from the Marcuses. Tomorrow. I'm Trish. Talk to you then.